Welcome to today's webinar through ISM New Jersey. The name of our webinar for today is Emerging Trends in Supply Chain Management. Dr. Robert Trent is a Supply Chain Management Program Director at Lehigh University, and he will be our speaker for today. Bob?
Okay, good. Thank you, Kathy. And good afternoon, everybody. I hope you're having a nice day. You have to excuse me a little bit. I have quite a head cold. I came back from China last week, and I guess I brought more than souvenirs. But it's not the flu, so which is going around. You know, we're going to speak about emerging trends in supply chain management, and I think a logical question, would be, where do these people who talk about trends come from? I mean, I don't have this crystal ball at home. I do, but it has a little fuzzy snow in it, one of those. But I don't have any magic crystal ball, and most people don't. The one thing that when we work in our profession in academics, we do a lot of research and we work with a lot of companies. And we see, a lot of things going on. I myself have, worked on and written about 5 different books in the last few years, the last 5 or 6 years, and a lot of research there and doing other projects right now. We've just finished a big project on supply chain risk management, one on collaboration, and we're taking up another one on global sourcing starting right now. So in there, you often deal with a lot of questions about where are we going, not just where have we been or where are we, but kind of extrapolate out. That's what I want to talk about today. So what I go over is in no particular order. Certainly feel free to contribute and ask questions as you see fit. If you were to sit in on somebody else's presentation on emerging trends, they probably have a different set of them. It's kind of like asking people, what skills do you think, supply chain people will need in the future? And then you wonder why you get, 10 different lists of those skills. So this is a little bit the same way. So what we're going to do is start right out. And what I'd like to do is talk about one of the things that I'm seeing very, very clearly is that the whole movement towards supply management, supply chain management professionals really increasingly being accountable for contributing to corporate level metrics. And that's going to be very important. The kind of metrics that we use in supply chain are increasingly going to have to be linked to what we do at the corporate level. Because again, we're trying to get the attention of executive management. We're trying to get them to understand really the one language of business, which is, frankly, finance. And if you look at everything we do in a supply chain, it ends up in one of 3 places. It ends up on the income statement and or the balance sheet and or the cash flow statement. And so when you start understanding that and the things that you do, then you can model, for example, then you begin to say, well, how do I affect these? And by, the indicators I'm looking at here are things like, return on investment, which, by the way, is a very, very misused term, which we could talk about for other reasons. But ROA is return on assets. ROIC, I will actually go over a little bit, return on invested capital. ROSMA is interesting. It's a new metric developed by A.T. Kearney called Return on Supply Management Assets. IRR is Internal Rate of Return. Then, of course, you have working capital and cash flow. And I'll give you an example. Let's say you're working in a supply chain and you say that your inventory turns go from 7 to 9. Well, that's great. I mean, what is that stuff doing? Those spinning around out back. But if I can go back and I can model the financials of our firm or of a supplier's firm, if I'm working with a supplier, and show what the increased turns did to the return on assets, since inventory is turning and it's an asset, then I think I have a much better chance of getting executive management's attention. We actually run a program. I'm not trying to sell it here, although I'm going to be doing it with Kathy in ISM New Jersey. We actually do some work with something called supply chain finance, where we actually look at various supply chain scenarios, and then we link them with appropriate financial tools and the metrics and show how to use the finance side. One thing I will tell you as we look out into the future, the finance side is going to become more important, but not necessarily to the finance people. They're not all that interested in what you're doing in supply chain. We need to be a little bit more interested in what finance is doing, since finance historically has been the corporate level entity here, not supply chain. But again, once you begin to articulate what you are doing in the one language that the executive level understands, then you are beginning to make a difference, I think, in the exposure and the impact and the visibility you have in your organization. I can tell you in the last few years, for me personally, I have learned a lot about finance that I never knew before, whether it's about hedging or whether it's about how to do a internal rate of return or a net present value assessment on a project, whatever it may be. So there's a lot of things out there, but rest assured that we are becoming more financially driven, and that means understanding finance better. So that's one trend we see. I take a look here, and I talk about supply chain management's impact on the ROIC. And that's return on invested capital. If you take a look at what drives return on invested capital, it's a function of revenue, costs, working capital, and capital expenditure. And for example, if you're involved at all with inventory management, I really think you should change. One of the things we're looking out into the future and saying, we're not going to call it inventory management anymore. More and more we're going to call it working capital management, because inventory makes up a big part of working capital. That's not all it is, but it makes a big part of it. So if you take a look at this revenue and costs and working capital and capital expenditures, you start to realize the impact that supply chain professionals and supply management professionals have on something called ROIC. Now, why do I bring up ROIC? Because it is increasingly becoming the preeminent corporate indicator for financial success. You can talk about earnings per share or net income and all that. I got that, but you can kind of game those a little bit. Return on invested capital really is an important metric because it's compared to your hurdle rate, or the rate of return you are required to make in a company as established by finance. If your return on invested capital is lower than that hurdle rate, then you're slowly liquidating your firm. So knowing how important ROI is, for example, I'll give you, when Daimler bought Chrysler, I used to work for Chrysler, okay? And when Daimler bought Chrysler, they ended up losing a total of about $70 billion on that particular merger. Now you might ask, how does money just disappear? How it disappears is when ROIC is less than the required hurdle rate. You are liquidating your company, and that's what happened. So the reason, that's why it's so important, because the executive people know that they look at that number and they have to see if it's above or below the hurdle rate. If you can show very clearly how you affect that particular metric, then I think that you're going to be well positioned as we move forward in our emerging trends. All right, let's shake up the old crystal ball, and then what we're going to talk about then with the same theme with finance is seeing supply chain professionals increasingly will apply financial thinking and analysis to supply chain management activities. And again, let me give you an example. In almost every company I ever work with, they view supplier development activities as an expense. And anybody knows when times get tough, the first thing you do is you try to control expenses. So cut travel, cut training, freeze wages, and, of course, cut supplier development activities. It's an expense. But I will tell you that the more progressive supply chain professionals, as we move forward, will understand how to present, for example, development activities as an investment, and they will calculate the internal rate of return, okay? So we may also then, like I said, talk about managing inventory in terms of working capital management. If anybody's interested, I have a little Excel spreadsheet, and what it does is it allows you, you put in the financial and other data for your firm or the supplier's firm, and you can do some, and it will tell you what your return on assets are. And then if you're doing some what if, say you're increasing your turns, maybe reducing your cost of goods sold through lower purchase prices, and you can, change these cells, it will show the effect on return on assets. And that's a very powerful tool, because now we're into what I call what if scenario planning. What if we got a 3% price reduction? What would that do overall to cost of goods sold? What if we increase the velocity or throughput rate of our inventory by 25%? What would that do for us? So if anybody's interested, I think my email is on the first sheet. You send me a little email, say, can you send me the ROA spreadsheet? It's very straightforward, but again, it allows you to model financially where we're going. And that's something we think, again, is an emerging trend. Well, one of the things we're also looking at is clearly the expanding domain of supply chain management and supply management. For example, years ago, all you ever were involved with was probably maybe direct materials, but maybe some MRO also. More and more we are seeing and working with companies where the supply chain or the procurement people are being involved extensively in capital expenditure projects, and that could be for equipment and facilities, and increasingly energy management. In our latest book, myself and a guy named Bob Rutsky, called Next Level Supply Management Excellence, we have a whole chapter devoted to capital expenditure project involvement, and an entire chapter involved committed to energy management. Now, what does that mean? It means that the scope and the domain of what you get involved with will expand. One of the things we have tracked over the years is the kinds of activities that supply management people, for example, get involved with is changing dramatically. Some of it's going away. We're not involved with transaction management like we used to be, but we're involved with buying and managing virtually every commodity and every category of spending you can imagine, including things like energy and healthcare services and temporary labor services, wherever there's a significant amount of money. So one of the emerging trends we see is that you need to get involved in more and more areas. What does that mean, though? It means that we had better expand our capabilities in our organizations. Do we really understand capital expenditures? Can we really sit down and work with engineers on equipment or facility discussions? Do we really understand the electric grid and what part of it is decentralized and what part of it is still regulated? So very, very specialized areas of knowledge will be, still required, and it's expanding as we go. So the whole domain of supply management, supply chain management, is not shrinking. It's actually, I think, getting broader if you take a look. I can show you a major company that not that long ago, only 17% of its total expenditures, total purchases, were managed by purchasing. And what that meant was everybody around the company was, had decentralized authority to buy what they needed. Well, as that company began to kind of consolidate and take a center-led view, well, it found that they needed those folks that could really manage a wide variety of items that historically they had not managed. So we see that, a good thing. We see that, that creates a need and a demand for supply people, and that should only increase in the future. In fact, I was joking, a friend of mine, I was joking not that long ago with somebody, and I said a friend of mine actually had to negotiate the purchase of a Gulfstream jet. Now, if you know anything about business jets, it's a premier top of the line. I've never been on one. They probably wouldn't let me on one. But if you have a Gulfstream, you've arrived. Although, if you own any business jet, I think you've arrived. And I asked him, I said, what do you know about corporate business jets? And he looked at me and he said, I know a heck of a lot more than I did 6 months ago. Because the point being that he was tapped to get involved with these other areas where there were, in this case, a capital expenditure project. And by the way, that's not an insignificant. That's a $50 million jet. So, that's not insignificant. One of the things, and I have a paper on this if anybody's interested. In fact, I was working on it this morning, getting ready to submit it. You're going to hear more and more as we go into the future about this thing called complexity. And I argue that it's really kind of the next generation of lean, in the sense that, lean was good, but lean is very mature. It doesn't mean that we can't use it. It means it's mature. Complexity is very across the organization, across the entire supply chain. But really, if you look around, and in my paper I talk about the causes of complexity, what it is, the kinds of complexity, and not all complexity is bad. In fact, companies that learn to manage complexity clearly can have a competitive advantage. And a lot of complexity is self-inflicted. I decide to buy from suppliers in China. That's going to be more complex. I decide to sell my product in 82 countries. Well, that's going to be complex, supply chain. So complexity can be a good thing. It can be a very, very bad thing. And we liken it to, believe it or not, cholesterol in your body. Your body has good cholesterol and it has bad cholesterol. And the bad cholesterol can even, is not a problem until it reaches a certain level. And that's the way we look at complexity. Some complexity gives you a competitive advantage because you can do things other companies can't. Now, what am I talking about here is that every survey, every analysis I see with executives, almost all say that the complexity of their business and their business model worldwide will increase in the future. So you really need to understand what this concept is. This is not going away. This is, I read in the Wall Street Journal, and I see this word used, over and over and over again, to the point it may become, ubiquitous and overused, like the word sustainability has become. But I'm seeing a lot of it, and you're seeing a lot of discussion about complex supply chains. So if anybody's interested in that, I'd certainly be glad to forward them a reading on that, something on that. But we are going to see that supply chain professionals will get increasingly involved in that area. If any cost accountants are on the line, close your ears for what I'm about to say. But cost accounting and cost accountants have done supply chain management professionals very little in the way of favors. They have done very little for us. There are certain things out there in the supply chain that we know are real, but nobody can articulate what they are. For example, if I'm going to transition or switch from one supplier to another, there are going to be things called switching costs. I don't know of any company that does a very good job, or any cost accountant that's done a good job capturing what those costs would be. And in fact, when you do supplier evaluation or total cost analyses, switching costs are almost always ignored. And that can be a very serious problem, okay? Because it may affect the total cost of the decision. So we know there's switching costs. We know there's things called transactions costs. I bought gas today, and I put in a credit card. I pump my own gas. In New Jersey, where I live, we can't pump gas, but I happen to be where I work getting the gas, which is in Pennsylvania. So Pennsylvania people can pump gas. They've all gone through rigorous training, and they're certified to touch those pumps. But the point I want to make is that's a transaction. And a transaction really is moving from one state to another. Not New Jersey to Pennsylvania. I meant one condition to another. When I go to an ATM, that's a transaction. Now, the point is, very few of us understand, or like, what is a material release, or what is something sent out under EDI? Those are all transactions. What do they cost us? Do we even know? Do we even have an idea? And for many, many years, and I think a lot of companies gave up, the Holy Grail was trying to understand this. And then the last one I put is total cost of ownership. I have a presentation on that that lays out 3 primary total cost of ownership systems that we tend to see in supply chain management. If anybody's interested in that, please let me know. But I will tell you that I think what's going to have to happen as we look out to the future, and I'm seeing the discussion already, is that we're going to have to get better for sure at total cost modeling. I'm seeing that that emphasis now. But again, other costs like supplier switching, like transactions costs, like opportunity costs, costs of quality even. Many of us do not do a good job articulating those. So we're really going to have to probably do a better job in our cost management systems, and I think we're going to have to do it. I don't think the accountants are going to do it for us. If you go back and trace the history of activity-based costing systems, you will find out it was not accountants that came up with that system. It was engineering, and specifically, I think it was at Hewlett-Packard, in the electronics space. So clearly, they felt they did not have a good way to allocate overhead, and so that would have been overhead cost allocation. But again, they figured out and invented a way to do that. I think we're going to see that with some of these other costs as we look out to the future. I think we're becoming more and more aware of the decisions that we make. There's a question about the validity of the decisions, and as we have less and less precise cost information, then the validity of our decisions becomes in question. I think a lot of companies source in China because they're not very sophisticated, and they just compare price. Well, anybody can see that if I'm paying, the equivalent of China $10 for a unit, here $14, that must be cheaper. But if I start factoring in, currency risk and logistics and inventory carrying charges and duties and customs, and if any third parties or brokers, and maybe any warehousing costs if it's been warehoused. So there's all sorts of things, and there's a lot of hidden costs, by the way, in international sourcing. in supply chains that never get modeled very well. So I think as we start to see those numbers, it affects our ability to make decisions. There's a lot of discussion going on, and where we're moving is, companies talking about, resourcing back to America or nearshoring in Mexico. And I would make the argument that some factors clearly have changed. Chinese labor rates are going up double digits every year. But I also think the currency exchange rates have changed. But I also think that companies are getting better on the total cost side with modeling their decisions. And I think they don't want to admit it, but some of them really, really made a mistake is what they did. And when they looked at the total cost numbers, it's not quite as attractive. I'm telling you, if you're only getting 5 or 10% on a total cost basis better, I would not, move it. That's just not enough for me to compensate, because I know there's a lot of hidden costs that we don't model very well either, and that might take away some of that 5 or 10%. So the same thinking with switching costs, same thing with transactions costs. But I promise you, we're going to be, as we're moving out, we need to get more sophisticated in those areas. Just finished a big study with 2 companies, and there's a paper that was in the Supply Chain Management Review. If anybody wants a copy, send it me an email, and I will send it out PDF to you. And it's about how to become a preferred customer to your suppliers. And it talks about the kinds of things you need to do. It talks about what suppliers expect from you. It talks about the kinds of benefits you might receive if you're the preferred customer. And again, let's be very clear why this is important. We think in the future, as markets become tighter, for example, whenever demand exceeds supply, it's a seller's market, and suppliers often have a choice. Who do they want to do business with? Do they want to do business with a company that, takes a 2% discount and still pays in 90 days, or somebody who's changing their requirements up to the last minute, or maybe one that doesn't treat them ethically or honestly? So again, suppliers, we think, are gaining power in the future. You're giving them longer-term contracts, which makes it harder to terminate a relationship. In fact, in our studies, I was shocked how long all these suppliers had done business with their customers that we were studying. 10 years was the average, and then that was the average amount of time. So we don't see a lot of supplier switching going on. So what does that mean? It means that you want to be, the customer that suppliers want to go to first if you have, limited capacity, or they do, or if they have new information they can share, or they have expertise like in engineering they could provide for design support. And in this reading article, it breaks up supplier-provided benefits into 3 categories and then divides them down into their elements, the unique items. So from that, you could say, okay, what kind of benefits am I looking to get when I'm the preferred customer? But I think that more and more you're going to see buyers realizing that a great deal of power in supply chains has shifted to suppliers. I work with a company called Boeing. We all know Boeing. I'll be on a Boeing jet tomorrow. And, if you look at the planes that are designing now, once they design in an engine provider, for example, General Electric on the 777, they've been that supplier forever. Now they're the sole supplier since 2002. So they're the only engine maker that Boeing deals with on that particular jet. And that jet's not going anywhere off, as far as, being, stop production anytime soon. So that's going to be another 10 years on that jet, plus all the spare parts requirements. So you have to understand that General Electric has a very, very high level of leverage, if you will, working with Boeing, because they have been designed in. So again, that's the power equation that we talk about in supply chains. But, no more can you just, say, okay, I'm going to give a supplier a contract, and I'm going to demand and tell them what to do. They don't do it, I'll threaten them. I think that the times are changing, and so we think supply chain professionals, as we look out to the future, are going to be much more in tune about what suppliers are looking for from the relationship with you. I keep a list of words. I call my list of shame almost, and it's words that we use in supply chain management, and we overuse them to the point that they lose their uniqueness, or how special they are. And one of those words is collaboration. Partnership is on that list. Win-win is on that list. Teams is on that list. Now every time we put a group of people together, we call them a team, and that just isn't correct. There's probably 15, 20 words on this list. Core competency would be a good one. If you had $1 for every time you heard one of your executive managers probably say the phrase core competency, you could quit the company and you could be sailing in the Bahamas on your yacht called core competency. Because frankly, it's so overused, but it's actually a very, very specific term in what it means. Not everything you're good at is a core competency, but that's what we tend to call it. I bring it up because that's what's going on with collaboration. Collaboration, if you have a spectrum or a continuum of relationships, collaboration would be at the far right side of high-level relationships. Collaboration represents really the highest form of relationship between a buyer and a seller or supply chain members. Now you might say, well, doesn't an alliance or partnership? Those are forms of collaboration. Okay, all alliances by definition should be collaborative. Not all collaboration is done in alliances. Okay, a lot of collaboration happens, for example, new product development, so it's project-based. But the point I'm trying to get at is you really need to understand exactly what defines a collaborative relationship, a collaborative opportunity, how to resource it, how to measure it, how to report it, how to support it. It's going to be very, very different from what the next level down of a relationship, which is called a cooperative relationship. Now, we like cooperation. That's good. But that generally features exchanging of information. Collaboration, of course, exchanges information, but it's beyond that. It's also resources, assets, risk. Okay? You could even have joint patents, for example. By the way, below cooperation would be competitive relationships. And those are your win-lose kind of relationships built solely on getting the best deal that you can get at any given time in the marketplace. So be careful, because what I'm saying here is that I think more and more companies, supply chain professionals, are going to understand what it means to actually have true collaboration rather than the pseudo-collaboration that we talk about or that sounds trendy or good. So again, if you understand what the word means, understand the opportunities, but every company that we survey, every company we speak with, I promise you, they're talking about the need for greater, real collaboration in the supply chain. And there's a lot of trends going on that are driving you to that. I'll tell you what, one company, we just did a big project through the Center for Advanced Purchasing Studies in Tempe, Arizona. In fact, we're finishing up the report now on collaboration. I remember what one executive said when asked, really, why do you pursue collaboration? And he said, with global competition today and the rate of change and the demands that customers put on us, we just can't do it by ourselves anymore. We just recognize that even years ago, we might have done some things that, frankly, we can't make the investment, we can't do it quick enough, we don't have the expertise, or customers are demanding new capabilities or services, and we have to work with people to help us to provide those. But I remember he said we just can't do it by ourselves. And once you understand that, and once you buy into that, then you realize the importance for strategic type opportunities. By the way, strategic is another word on my list of overused. Once you start calling everything strategic, then I can't tell what actually is strategic. Be very, very careful on that. So I think we're going to see the true collaboration, but I think it's going to take people who understand it and can spot those opportunities. And those opportunities, believe it or not, are going to be few and far between. True collaborative opportunities, because they're so intensive, you can't manage more than a handful, 2 or 3 maybe at a time. So it really depends. Now, in the old days, going back a few years, it would have been in alliances, but now I'm seeing that collaboration being applied more in the context of projects. Projects for maybe developing a new facility or a new product, whatever that may be. So there we go with collaboration. This one, I think, is a no-brainer. and it's a no-brainer when I talk about focusing on talent management. Now, by the way, I got to be careful here. Talent management, which is an entire chapter in our last book, is now becoming one of those terms that everybody throws out there. And people are saying, oh, that's just human resource management. That's just human resources. And the truth is, there is some truth to that if we just decide to change the term human resources with talent management. But talent management is a little bit different, a little more involved. You start to get into things like talent analytics, which I don't want to get into here. But let me tell you why this is important. Last year, something started to happen in the United States. Every 8 seconds, somebody from the baby boom generation started for the first time to turn 65. And if they have a defined pension plan instead of a 401 that would have tanked after 2008, a lot of them are heading out the door. We have a local utility here, PPL. They're talking about half their workforce leaving in the next 5 years, 5 to 7 years. So the question will be, where will the next level of talent come from? Okay, and that's why supply chain professionals, you need to focus on your skills, but also where are you going to obtain the next talent? Do you have relationships with universities for preferential treatment? We work with companies here at Lehigh in our supply chain program, and if you're one of the regular companies, we call you. You're the customer in this case. We're the supplier. You're the preferred customer. We give you access to the resume book earlier. We will set up meet and greet sessions specifically with students. We will give you our department conference room to interview students instead of the bullpen in career services. We'll give you all kinds. We'll help you, guide you through the cycle time or the life cycle of hiring during a year. The windows are changing when companies need to come in and hire for full-time and internships. So we'll actually help you with your counseling on that. We will introduce you to the head of career services so you can form a relationship with that group. And the bottom line is, the objective is to give you preferential treatment so you walk out of our institution with hiring the better students, okay, if not the best. And there are some companies that come here every year, and they consistently get the best students because it's become almost routine in our relationship with them, how we help them with the career fair. I mean, that's what you're trying to do when you focus on talent management, okay? We'll help you set up internships. If you haven't done that before, we'll help, advise you on that. And all again, that's just part of the relationship. So again, it's beyond just a transaction where you post a job, come in and interview one day, and then make an offer to somebody, which they may or may not accept. We've also then, so when you're looking at talent management, after you have people, then the question becomes looking at how do we retain them? How do we develop them? Okay, how do we manage their careers? And that's all part of talent management. There's probably 6 different focus, kind of a different focus in talent management when you break it down. But I will tell you this, you're going to hear this term a lot because of the demographics. I'm a baby boomer, right? So I turned 55 in March, so I'm not near 65 yet, but I'm getting close enough to start saying, you know what, I got to start. I'm thinking about that. So the thing about baby boomers is the generation that's following them or following us is about 14% smaller. So you're either going to have to work harder to get your talent, or you're going to have to become more efficient and be able to do work with fewer people. But the pool is getting smaller. So something to think about, talent management. More and more we're going to see supply chain professionals being asked, what have you done to grow top line, which is revenues? And this is a very, very hard thing for supply chain people that have really focused mostly on cost management. But more and more, what have you done? So think about what that means. It means maybe I work with suppliers that bring features to differentiate our product, that help us get to market quicker, that lead to sales. Okay, so we're really expanding our domain of where we get involved, but also in the income statement where we get involved there. It used to be just cost of goods sold. You took sales minus cost of goods sold equals your operating profit. But now we're looking at not just cost of goods sold where we manage it, or on the balance sheet where we manage inventories. We are now looking at what can we do on the top line. And a lot of that's going to be through what we call innovation sourcing. Your ability to go out to suppliers and not necessarily buy things as much as contract for their capabilities, which eventually then will lead to some things you buy. But, literally their design capabilities, maybe their knowledge of composites. If I go back to aerospace, General Electric is putting a big, big, big push in composites into the engines to make them lighter, more durable. So do I tap into that? Will that differentiate that engine in the eye of the airline buyer? So again, you're going to start seeing that pressure. I think that's going to be a rude awakening for particularly people that have just been used to very operational measures that have been very cost-focused, if you will. So we think that's going to happen. We could spend a lot of time on risk management. One of the things that we're looking at is starting to view supply chain management and risk management as overlapping. Right now at companies, you have what's called ERM. And you've always had ERM. It's called Enterprise Risk Management. And that's risk management at the corporate level. Now, partly why you've always had that is if you're a publicly traded company, the SEC requires you to divulge your material risks in your 10Q report, I think it is. Not the 10K, I think it's the 10Q. So therefore, you're thinking of risk. Below that, we have something called SCRM, Supply Chain Risk Management. And that's been usually pretty lower level. But now that supply chains are global, and now that we've seen the impact that disruptions have on supply chains, whether they're volcanoes in Iceland, or a tsunami and flood, an earthquake in Japan, or tornadoes, or whatever it may be, you start to realize the business continuity impact. So we're seeing supply chain resource management, unfortunately, in a way, being elevated. And if I say unfortunately, it's because it's becoming a more precarious world. And with that, we're going to start to see, I think, supply chain people assuming responsibility in their normal duties for risk management. Today, it's often separated in organizations with people who are clearly involved in risk management. By the way, in supply chain risk management, we typically break the risks down into 4 categories: operational risk, hazard risk, financial risk, and strategic risk. And to me, I've seen a lot of ways to break out risk. That is probably the best way in a supply chain, because I can pretty much put every risk event into one of those 4 areas or more. Some have an effect on more than one area. So we're looking at that, and we're starting to say, okay, now how can we do risk sharing with suppliers? So maybe in product development, there's always a strategic risk and even financial risk that we put money forward and the product fails. Well, what happens? Maybe the supplier helps put in some financial. But more and more, you're going to see something called predictive analytics. It is the next big thing. Now, some people call it business analytics. It's kind of a subset of the thing you're hearing called big data. Big data, we got all this data, and let's do something with it. This is not data mining. Let me be very clear about that. Data mining is really different. We're looking for patterns. We're looking for, what a customer in Syracuse, I know there's people from Syracuse, what are they buying? And, can we, say you go to one of the casinos in New York, Turning Point Casino, let's say. And you go there and they know all about you. They know what you like. They know where you eat. They know what kind of games you play at the casino. That's data mining. Predictive analytics says, what's going to happen in the future? And we're applying it all over the place. For example, I may have a shipment due 10 days from now, and I already know it's going to be late. There's something called telematics that are being installed in trucks. And telematics read in real time the performance of the engine. Just like with an SPC chart, it can start looking for non-random behavior, and it can actually predict when and what kind of problem a truck may have. It may even send a signal to the local service center, the next service center, and say, you got a truck coming in, this appears to be the problem, so they can be ready. So again, all these things are coming along. There's discussions about appliance makers putting sensors into your refrigerator, in your dishwasher, that would sense performance and then identify problems before they occur. Predictive analytics is the big thing. It's a quantitative play, if you will, and it's not forecasting. Forecasting is different. Predictive analytics is really trying to look at behavior. It's looking at occurrences. Let me give you an example here that I liked. This is from the Summer Olympics, and this is what the Wall Street Journal, working with some modelers, predicted would happen at the Olympics. 108 medals for the U.S. all the way down. Now, if you take a look what comes next, there's what actually happened. So, 104 medals instead of 108. China, 92, actually got 87, but the exact number of gold medals. So if you were to correlate column A with column B, you'd find it's pretty good. Now, it actually gets better as you get down to the smaller countries, because they said, okay, we predict they will win none or one or two, and they were almost precise on those. So interestingly, the rank order is exact, except Australia, 42 predicted, 35 actual, and only 13 golds, but 7 actual. My sources on the internet tell me they put one too many shrimp on the Barbie and maybe partied a little too much in the off season. Japan, again, also predicted medals fine, but gold down. So, again, it's a very complex process, and there's a lot of events at the Olympics. I think there's like 300 events with, 3 medals each. But look at how precise. Now, did they actually predict the winners? No. Some of those gold medals would have been somebody maybe they didn't even predict the win. But overall, if you look at the macro level, predictive analytics, the numbers were very, very close. And that's what companies are starting to do in supply chain. At Boeing, they have a system called SYNC, Supplier Insight and Control. And there, the supplier is actually putting in data that Boeing then runs through algorithms to help them understand if they're going to project a quality or delivery problem in the future. And so then they work, to try to be proactive and work with the supplier. So that's something I think you'll hear more and more of as we move forward. Now, I'm not going to go through all these. These are made available. These are just predictions going back to risk management. As we look forward, what we see will happen in the area of risk management. And I really think you should take a look at these. They're the result of a research project working with 15 major companies around the world with 4 different sets of interviews at each company, looking at cases, best practices, corporate practices. I mean, really going at it. So, there was, several hundred people involved with this project. And in the end, we step back and we say, okay, after we looked at all this and what we're seeing in other companies and what we're seeing in the literature and the popular press, what are some predictions? Where are we going? All right. And so everything from your appetite for risk to, moving from a pockets of excellence model to making it more, really enterprise-wide, if you will. We're seeing a great increase, or we will, in risk management tools. Some companies develop their own, and that's pretty typical, by the way. When I was at Chrysler, I worked on a team with 5 Chrysler people, 3 IBM people. And we actually developed our own warehouse management system for our distribution center. We developed our own and then had a contract programmer program it, but we developed all the functionality and the features. And why did we do that? Because back then, there was no such thing as a third party that could sell you a warehouse management system. Today, there's hundreds of them. So this is typical what we see in the life cycle of software evolution. Right now in risk management, we are not seeing a lot of third-party available tools. We are seeing some, and they are predominantly to help you evaluate and predict supplier financial risk. But operational risk and some of the others, hazard risk is another one. Now, can I predict when an earthquake will occur? Actually, there are models that will try to do that. Looking at seismic activity, proximity to fault lines, things like that. So again, there are models out there sophisticated to do that. So I just, bring it up because I think that's what we're seeing. Some companies are developing their own. I think in about 3 to 5 years, you're going to have an abundance of products available to help you in the risk management area. So keep that in mind if you go in that route. And I think you're going to see more and more companies, really modeling risk in their total cost models, and so on down the line. Okay, I'm going to show you what is universally my students tell me their favorite slide in any PowerPoint presentation. That's the last one. There we go, the last one. So, I went through and I'm talking about, you see a lot about the financial, about risk management, about predictive analytics, about what's going to happen in the talent arena. And so I guess I'd really like to open it up. I'd like to hear if you have any questions or comments or things that you're seeing in your supply chains.